around, we have special guest Danielle DiMartino Booth. She's CEO and Chief Strategist out at QIResearch.com. That's QIResearch.com. She's an economist, former Fed insider, and author of the seminal memoir of that time called Fed Up. She's all over podcasts, financial media. She's a regular on Payne's show out at Fox Business. And again, we're honored to have her back on. Danielle, thanks so much for coming back on. We really appreciate it.
It is great to be here on CPI Eve. It used to be that non-farm payrolls was the big day in the markets, but it's clear that inflation has taken that place.
Yeah, and thank goodness for that, as far as we're concerned.
Of course.
Yeah, but in any case, let's get right into it here because I know you have a hard out at a little after 10 this morning Eastern time, so I want to make sure we get to all of your thoughts. And as usual, you're the contrarian. You're stirring up the punch bowl, as we like to say. I think your latest thesis, if I read it correctly, is you believe the U.S. might already be in recession. First off, did I read that correctly? And second off, what the heck?
You did read it correctly, and it's just there's nothing controversial about my call at all, unless it's different this time. And maybe I'm older than most of the people on this Twitter Spaces, but I was kind of raised on a trading floor to be very wary when somebody trumps out. It's different this time. The Bureau of Labor Statistics, I'm sure you're familiar with them. They have been running state level unemployment rates since 1976. And in 9 out of 9 instances since 1976, that 50 or more of US states, including Washington, D.C., which makes the tally 51. But in 9 out of 9 times, when 50 of the 51 have rising state unemployment rates, the United States has been in recession. It's pretty simple, and that's where we were in October. So we've since had many validating data points. We've got full-time unemployment, full-time, right? The last time the United States created a full-time job net as opposed to part-time was February of 2023.
Wow.
So there is vast amounts of evidence after last Friday's jobs report, especially, that are corroborating signs that we've long since fallen into recession.
And just a kind of a
Yeah,
cursory. Go ahead, Stefan, as our
yeah,
CEO.
no,
Stefan Rusko.
I'm just sort of, echoing on Danielle. I mean, what I love about you is you're just constantly out there highlighting at any point in time the state of the economy. We don't have to wait for a month for you to pick up another statistic that comes out and another metric that we can track and monitor. And so, based on that, I think it'd be really interesting. And I'm super excited to hear Oliver, who's got this view that we're going to enter into stagflation coming in. So it's going to be really interesting to see in these spaces and where the thought processes go. As we don't need to wait 1 month and all the time till we get some of these metrics and see the performance of an economy.
I actually think for some players in the economy, stagflation would be the lesser of two evils. I mean, the biggest impediment to the contraction in full-time jobs is what that does to the potency of pricing power, and it eviscerates it. All you had to do was listen to C-suite occupants for the entire earnings season. That's all you had to do was open your ears to hear them say, we cannot raise prices anymore. We had HAD, past tense, the ability to pass along price increases in recent post-pandemic years. That seems to have disappeared. And that's why, oh, by the way, little footnote, asterisk, that's why, along with announcing our earnings and the fact that we're losing pricing power, we're laying off a good chunk of our workforce. Because one way or another, my bonus, oh, I'm sorry, they didn't say it that way, but one way or another, earnings per share basis is the basis for their competition. So they will cut costs to shore up profit margins. They have no choice. They answer to shareholders. that again is just a fact of life. People think I'm making this up and it's greedflation. I'm like, they want to go back to the greedflation days. They yearn for them. But that's no longer an option. With Uncle Sam, Uncle Sam's not going to write a check until April of 2025. And I think that that's the question few
Interesting.
people ask is when is the next time Americans are going to get cash in their hands?
Hmm.
And do you not think that if they reduce interest rates at some point, when they do, I mean, we don't think it's going to happen anytime too soon, but when they do drop the interest rates, that there's these $6 trillion that are sitting liquid in money market funds, that they won't immediately get unlocked and released into the economy, but then you still have the sort of whole trickle down economy, right? Versus some sort of direct, Inflation Reduction Act or anything similar to that.
Well, I mean, trickle down in what sense? I mean, trickle down's never actually worked in the real world. So that's the only
Yeah,
reason I bring that up.
that's true.
Is trickle down just doesn't work. It doesn't work in a beneficial in a way that benefits anybody in society. And my question would be, where is the money going to go to? If you're a
Hmm.
high net worth investor in today's day and age, and 25 basis points in June or July compels you to move your money, there's something that you're fundamentally not paying attention to in terms of credit and stock market valuation. Your eyes are closed. Again, if we're just talking about 25 basis points, if we're talking about 75 basis points, well, then there's been a credit event and you're scared out of your mind and you're keeping your money in cash anyways. So, but 25 basis points is not going to do it. It's not going to move the needle given the backdrop that we have in risk assets. I mean, anything that is a gauge of animal spirits has gone absolutely haywire. And if we do have a credit event, then all of the exposure of small cap stocks, especially, and the massive buildup that we've had in the credit markets will be immediately exposed. And that's what people they need to have a better realization, appreciation of. It's that this is not 2000, the year 2000 redux. This is the year 2000 and the year 2007 redux put together in a petri dish, which we don't know what that looks like.
Wow. Wow. If you're just joining us, we have former Fed insider Danielle DiMartino Booth as our honored guest for this first segment. Right after her, of course, we pivot to our head of product, Oliver Roost, for his inflation analysis. He too has a pretty interesting thesis, but we're kind of working under the assumption here, as DDB has outlined, that the U.S. is pretty much already in a recession. And I think anecdotally, just looking at headlines, our head of data, Ivan Yelik, he often will shoot me in Telegram or DM me the latest layoffs from shoe companies and beyond. So I noticed, Daniel, that you were mentioning um, layoffs and jobs. I guess is that really the telltale sign of a recession, or is it more to it?
No, it really, really is as simple as paychecks equal income and spending capacity. It really, really is that simple. And there were some really strange aberrations that came about in January and February when you added up the shoes on the ground, individual tabulations of layoffs that were announced, just public announcements. Okay, so you're not following like what's going on deep, deep, deep in the wind, in the weeds. Excuse me. That was about 183 some odd thousand for those 2 months, and that's an extraordinary number. Again, you have to go back to 2009, 2010 to see those kinds of 2 month numbers. And I kept, and I said to our clients going into Friday's non-farm payroll, buckle up, you're going to see quite the revision. Now, I didn't even know what to expect. I didn't know that it was going to be of that magnitude. I was inside of the Bureau of Labor Statistics revisions tables, scrolling. Of course, you scroll past the pandemic, right? You forcibly, violently close the world's largest economy. You forcibly open that up. That does not constitute a recession. That constitutes a man-made event. So
Right.
scroll back past the pandemic noise, I had to keep scrolling down, 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 down. I'm like, okay, where's the precedent to 1 month negative revision to non-farm payrolls of negative 124,000? And I finally got there. Stefan, you might be the only person who can answer this question. We'll see. But I finally got there to September of 2008. Can anybody turn your speaker off and tell me what happened in September of 2008 when we had negative revisions to non-farm payrolls of negative 125,000, 1,000 more than September 2008?
Yeah, I wouldn't be able to answer that one. But I mean, we know that 2008 was the GFW, right? The global financial crisis that took place.
Yes, well, yeah. September
And
was when
yeah,
Lehman collapsed. Yes.
yeah.
There was a little investment bank in New York City called Lehman Brothers. And in September of 2008, Lehman Brothers collapsed on the heels of the Daily Feather today was titled "The Ike Dike." That was 5 days after Hurricane Ike, the worst hurricane in 100 years, struck Galveston and took that puppy offline. Small city, Houston. And so between those two events, we had a negative revision to non-farm payrolls of negative 125,000. So remind me, Stefan, next time. You're much younger than me. But even if you look back at temporary share of non-farm payrolls, that has been in a nosedive. The temporary share of non-farm payrolls is about 1.7%. In December of 2007, when we were entering the Great Recession, it was 1.8% of payroll. So companies are shedding their contract workers, their extra workers at a rate we have not seen since 2008. This is no longer a drill. This is DEFCON 1. And you can choose to ignore it, or you can choose to make sure that your portfolio is exposed to companies that have enough cash flow. I don't care about profits. Anybody can make that up. That companies that have enough cash flow to continue paying their dividend. Otherwise, we're going to see what we saw 2 weeks ago. 220 billion or so market cap companies in 1 week slash their dividend to the bone. So you have to be very careful right now with who has their hands on your cash.
And you know, there are a large portion of tech companies that also are sitting on large pools of cash reserves, right? So on their balance sheet, they have a whole set of liquid assets. What do you think that's going to happen with that? Are they going to just hold on to that? Are they going to redeploy that in terms of investing in AI, which they're already doing? Or what? How do you see that sort of evolving? And will that be a saving grace?
Well, there will be a saving grace to the companies that are building their internal AI operations and using their cash for it. Of course, there is something called that you do not learn about when you go to business school. There is something called second mover advantage. And what that means is you look to the first mover and then you capitalize off of all of their innovating by coming out with a better mousetrap, but using their sunk costs as opposed to your own. And that way you make a company that is, the absolute wonderkind of the world. Did I use the N? I hope I used the N. I hope I didn't. Hope I didn't Ted Lasso that one. But you use the absolute first mover and all of the capital that they've expended, so that you can come up with something that's a lot cheaper. And then you put their price model out to camp, and then you capitalize on that, or you make sure that you sit on that war chest of yours in case anything should go wrong. And Danielle is right. And March and April 2020, if they didn't constitute a recession, I argue that they did not, because that was a man-made event. So in the event that you're in the 176th month of an expansion, you make sure that your cash is on hand, because you know what happened after the 120-month prior record holder expansion in US history. Again, I go back to the fact that this is not 2000, this is not 2007. This is the two of them combined.
It's crazy when you put it into months like that. It's very, very sobering. We definitely want your questions. If you're just joining us, we are with Danielle DiMartino Booth, former Fed insider, economist, chief strategist, and CEO out at QIResearch.com. Again, we want your questions, comments. We've got a couple already requested. Speaking of which, our head of data's got a question. Go ahead, Ivan.
Great to be here again. And Danielle, since you're speaking of the Fed as well and what they monitor in regard to the decision on what to do with the rates, and also are we considered to be in recession? You mentioned labor market data, you mentioned inflation data, but also one thing that they probably monitor is the financial system. And yesterday was actually a whole year since the Silicon Valley Bank was shut down by the California regulators. Do you see any signs of issues in the financial system, or that's pretty much the stable part of the whole equation?
So, I mean, you could theoretically see every every wounded animal that's way out on the pasture. Sorry, I'm from Texas, bleeding. Pony up to this BTFP on the final day of its existence. But right now, we would know if there was anything systemic in New York Community Bank, and financial conditions would be much tighter. So I should talk quickly out of the other side of my mouth and say that even though the 325,000 jobs created in January, some to 600,000 jobs created when you add in February's 275,000 jobs, I should be careful and say that that is the data that Jerome Powell is going to reference. If you see natural gas and healthcare prices that are hot in tomorrow's CPI, he will reference that. Jay Powell will reference sticky inflation until the cows come home, even though we know that what's happening in hotels and restaurants and eating out tells us exactly what's happening with services spending, and that is in a disinflationary spiral. It doesn't matter what Powell references, is what matters to markets. And part of the reason that he's sitting on data and referencing it, even though the lawyer in him, right, he's not a PhD in economics, even though the lawyer knows it's specious data, but he's leaning on that because financial conditions remain so very easy that they give him the leeway that he needs to continue shrinking the footprint of the Fed's balance sheet, which is paramount to him. He'd rather not be conducting quantitative tightening while he's already lowering interest rates, even though he said he'll already do it.
I've got a couple of requests here. Looks like Captain Franz, you are up to ask a question of Danielle DiMartino Booth. Go right ahead. Captain, you're up. If you have a question or comment.
Sorry, I was on mute.
All good.
I just wanted to agree with Danielle on one point and add another statistic that really jumps off the page to me, and that is if you look at the rate of change of government jobs versus the rate of change of private sector jobs, that right now the rate of change of government jobs is double the rate of change of private jobs. I think the numbers are roughly 3% growth versus 1.4% growth. And to me, that really underlines just the weakness of jobs in the private sector. And I just wanted to point out that statistic that I've never heard anybody else reference.
So we follow government job creation very quickly, very closely. In the month of July last year, it was kind of the seventh month in a row of downward revisions to the initial print. It was kind of miraculous, if you will. It was like the second coming of Christ, but it happened at the BLS that they managed to find 131,000 positive job revisions when they reported August in September, and they were all government jobs. It truly was a miracle. And the other revisions were to the private sector were negative. So yes, government job creation has been very anomalous in the last 12 months. We've been watching it very closely, and that is a direct corollary to the fact that the private sector, again, has not created a single single full-time job since February 2023.
Yeah,
Wow.
we've seen that same metric, right? We've seen government employment grow significantly throughout not just the last year, but even beyond that. The whole COVID period, nobody was hiring but the government, right? And so ultimately, we've now grown this huge apparatus that has now become this huge institution, which is about protecting jobs and about protecting their positions of power, which is ultimately going to drive a lot more regulation, a lot more forms, and a lot more bureaucracy that's going to impede further growth.
It will, every single penny that is invested in the public sector, it acts like a leech in medieval times, and it just pulls all of the blood out of the apparatus that is the private sector. Every single marginal dollar of incremental investment, that's what it accomplishes. In the 11 months through November, there was 120% of positive government social safety net growth in the state of New York, meaning the private sector net shed 20% of its employment. The more you put into the public sector, the more you pull out of the private sector. It is the worst thing that you can do, unless you're, I don't know, the USSR of old.
Right. And it is.
There's
Go ahead.
there's a really interesting curve that came up and that we stumbled upon a while back, the army curve. I don't know if you've heard that. And it's really about trying to weigh off, sort of what is the optimal level of government intervention to stimulate the economy, right? Where's that balance and where do you find it? And they use a lot of what it takes, what's the cost of a Big Mac, and what's it take to produce that Big Mac, and then ultimately what's that in relationship to the GDP, and then correlate that to the MSCI of a specific nation, which I thought is really interesting, right? And you can then see that they sort of land out in a sort of ideal situation where an economy is spending just below, sort of 20% of their GDP in government spending as the optimal, right? And
That means that
the
we're,
US is currently
yeah,
at like 40, 50%, right?
right,
And
yeah.
like
We've wandered completely off the reservation
yeah,
when
exactly.
it comes to that. My mentor, Dr. Lacey Hunt, uh, he wrote the book and amended it years later about the perils of falling down this rabbit hole of increasing reliancy on the public sector. And I fear for where we're headed, because when push came to shove with the United Auto Workers strike, you saw General Motors and Ford walk away from their electric vehicle investments. And again, I will re-raise the term. That's a sunk cost. So they're even walking away from money they've been given.
Hmm. There's kind of an inverse relationship between that of government employment increasing and the private sector contracting. So it's fascinating. And the when Captain said it was twice that of the private sector, that was pretty scary. Again, we're taking your questions, your comments for Danielle DiMartino Booth. Next up is Kane for Life. Go ahead, Kane. Any question you might have for Danielle DiMartino Booth?
Good morning, Danielle. I've had the pleasure of meeting with you, as I'm a member of the Art Cash and Friends of Fermentation group at Eric and Victoria's Christmas holiday parties. And you are a plethora of knowledge. I'm an old fogey at 55, 30 years on Wall Street, mentored by Arthur and Dennis. My question to you is, given the political skullduggery that we are seeing, do you believe the ruling class elite will allow the market or the economy to tank in an election year, or worry about it after 2025? And I agree what you're saying, by the way.
Well, the biggest impediment right now is that there is a loss of control across most cohorts, even the elite. Even the elite cannot get this Congress to do much beyond keeping the lights on. I mean, it seems like every major announcement is, oh, we've bought 5 more weeks, that the government's going to stay open. Woohoo! So my point is, I really don't believe that we're going to see major stimulus measures until April of 2025, right? April of 2021 was when Biden issued that $1,400 third stimulus check. That was the balance paid on the $2,000 that Trump had asked for. Trump asked for $2,000 for the second stimulus check. He was given $600. Joe Biden got the $1,400 balance, and we went on our merry way to double-digit inflation. I don't think that we're going to be there to where we're sending out checks directly until we have a Congress that's willing to do more than just keep the lights on. The reason I bring this up is because in a true recession, which I believe we're in, not even the financial markets can hide from a true recession, because that has implications for the top line of companies as opposed to the bottom line, which can be manipulated 6 ways to Sunday. So true recession will not, when the Fed starts to lower interest rates, it will not be a day of celebration. It will not be a day that you'll be like, oh, here comes inflation. It's exactly the opposite of the case. By the time the Fed usually starts to lower rates, especially when it wants to willingly commit a policy error, Jay Powell, knowing that you've already passed the Rubicon, crossed over that in order to keep shrinking the Fed's balance sheet, which works against the elite, which works against the people who'd rather run the financial markets on behalf of the Federal Reserve. So it's a very interesting backdrop. But by the time we get to rate cuts, we will already be in the soup.
Yes, I agree. What about the RRP account? That's basically Yellen's financial maneuvering, and the money put the brutal 2022 bear market to a stop and reignited the stock market. I mean, how much have we drawn down in the last couple of years? The last I saw was over $2 trillion.
So it peaked at 2.553, and we're down to, I think, we're down to about 433, 445 billion. The thing about that is, everybody follow John Comiskey. If you don't, on Twitter, he's done a really good free piece on Substack that you can read that walks you through the math of why and how, especially if we have very small rate cuts. Let's just say 3 25 basis point rate cuts. He walks you through the math of how the RRP can still be close to 150, 180 billion dollars come December the 27th. Fascinating times again that we're in, but if there's no real alternative, and it's not also a treasury bill, if rates are coming down that slowly, we might actually end the year with the RRP with a positive balance. Believe it or not, hate to break it to Janet. I hate to break any bad news to Janet, though. You know, it's just, I'm a nice person.
Hey, Kane, DM us about your microphone. You were crystal clear, and I'm insanely jealous. Next up for a question for Danielle DiMartino Booth is this is gonna make me laugh. Carlos Danger. Carlos Danger. Do you have a question for Danielle DiMartino Booth? Hey, yo, Carlos. Do you have a question
With,
for
with that name, I hope he does.
Carlos? Do
Yes,
you have a question?
thank you. So Danielle, I think everybody's ears perked up last week when Jerome Powell gave testimony in Congress, and there was a reaction. I think everybody had a reaction to the banking regulation, where well, everybody has an opinion on it. I would like to know your reaction to the Basel III, kind of walking that back. And is J.P. Morgan ghost and J.P. Morgan incarnate Jamie Dimon? Has he won and bought politicians to walk that back?
I think walk that back is going to end up being, hopefully, historically, a little strong. It's with good reason that he defers the Basel III Endgame to Michael Barr, who has not backed down. You'll probably see some concessions on capital requirements, some concessions on capital requirements, but the meat on the bone has to do with overnight lending and the securitization markets. And I think that those are the aspects of Basel III Endgame that Jay Powell wants to stick around to see through the end of his term. That would be May 2026. So he's got about 2 more years here. And since I'm on a live Twitter Spaces, big shout out to Jay Powell. I was never a big fan of his, but it has been almost 2 years since he's held the line on the tightening stance. So good for him. But no, I think that Basel III Endgame is a massive political hot potato, and I think that Jay Powell will continue to quietly say, kind of like he's done with CBDC, oh, we're working on it. Oh, I'm sure there'll be some concessions, and it will probably be in the form of capital requirements. But again, the focus is on overnight lending. There are great primers to read on Basel III Endgame and on why JP Morgan Chase's 3/4 of its business model, they are capital markets, and they help to run the businesses of the huge non-banks that are too big to fail by proxy. And I think that that's the bigger of the two goals here. So very, very complicated question you just asked me. And I'd be happy to send you some primers offline if you want to DM me.
Very nice. We're heading into the stretch here for our time with Danielle DiMartino Booth, former Fed insider and chief strategist, CEO out at QI Research, QIResearch.com. Running into about the last 6 or so minutes. So get your questions in. Looks like we've got a question from a listener, Ibrahim. Ibrahim, come on and ask a question of Danielle DiMartino Booth. Ibrahim is connecting. Ibrahim, do you have a question for Danielle? Okay. Ibrahim, last chance, brother, and then I gotta move on. Okie dokie. If you
Well,
can,
post it
yeah,
online, and we'll
yeah,
answer it in the written word. How you go? There you go.
yeah, do that. Post in the thread, and we'll get at you. Let's see. Looks like the final question then will come from El El Lechero. I love these handles. Um, El Lechero, you have a question for Danielle DiMartino Booth.
Hello, can you hear me?
Yeah, go right ahead.
El lechero. Wow,
El lechero, sí.
that's
Uh,
that's bold. Mhm.
no, I had a question regarding what your guys' opinions were with this information coming out of China regarding that they've seen the first bit of inflation in the new report that came out. It looks as though inflation is rising for the first time in many months, and also, it came out that they purchased, I believe it was 12 tons of gold. To me, it looks like they're clearly preparing for something, and I'm curious. If you think there's going to be significant bleed over into the U.S. and what that would look like.
Um, I'll take a shot at this as quickly as I can, which means that means to say we need about an hour to go through this. But the long story short is uh, the buying of gold by central banks is a global phenomena at this point. I think that if iron ore and steel would not be where they are right now if China had a bunch of extra cash on hand, and they might have actually also done something on a military level at this point as well. We have to recall right now the calendar is completely upside down. We did just have a huge chunk of the country travel, and we did see a pop in inflation. Does that mean that the property crisis has ended? I don't think so. I think you're going to have to wait to get through the New Year noise, and I dare say, like Washington D.C. bureaucrats, the optics of deflation were getting to be very heavy, and it's never been beyond the CCP to manipulate data. So they might have wanted a little nice little plus mark in front of the inflation for 1 month. Let's see where we are in about 2 or 3 months, because again, this property situation is not going anywhere. If you want a real read into the Chinese economy, always look to iron ore prices.
Excellent, excellent, excellent. Well, we put you through the paces
So
here. Go ahead, Stefan.
I think if you look at that, just adding into that, right? I mean, if you look at that, I think China's going to have to stimulate its economy, right? And they're going to go into printing a lot of money, which is from a global liquidity side, is going to add a whole new set of liquidity into the markets. And I think one thing that we've learned is that you've got other currencies, but gold, but one of the currencies where a lot of people around the world, US dollar still dominates, right? I think like 80% or 90% of worldwide trade, 80% is denominated in US dollars. And
87% of daily currency transactions are in the dollar. Yes.
Exactly. So where is all of that liquidity going to go? It's actually ultimately going to go, and countries that are suffering inflation, Turkey or Argentina in the past, or Latin America or Africa, a lot of these nations are going to be looking to buy the US dollar, even at a retail level, so that they can hold and store value to whatever extent they possibly can. So ultimately, that's going to be, the US is better off than most other countries. As a result, it's going to benefit from the demise and the struggles that other countries have.
Couldn't have said it better. Completely agree.
Yeah, world reserve currency. Danielle DiMartino Booth just put on a clinic for 40 straight minutes here. We really appreciate your good humor, your time, and your trouble. She is CEO and Chief Strategist out at QIResearch.com. Do go there. Do sign up for the newsletter. It is mandatory reading. Do not walk a block without it. Danielle, how can people in other ways follow your work and keep abreast of all that you do?
So, the easiest way to take a bite out of QI Research is to start with the Daily Feather. Come to dmartinobooth.substack.com. Love to have you as part of the QI community. If you don't already follow me on Twitter, please do at DiMartino Booth. For whatever reason, you'll find that I'm pretty consistent. I never hold back.
It's a great follow. We really enjoy it. Danielle, thanks again so much for your generosity and good spirit here. And enjoy the rest of your day.
And thank you. One last word, Truflation audience. Correlations are easy to create in shorter time frames. That does not stop me from saying that since the Federal Reserve started tightening, the correlation between headline CPI and Truflation has tightened from 0.97 to 0.99. You follow Truflation every day. Listen to me.
Boom.
And that's a large credit to Oliver and to Ivan, who've been super silent on this call, but love it. Great to hear. Thank you, Danielle.
And that's a great segue. Thanks again, Danielle. We
Thank you.
appreciate it.
Take care, gentlemen.
Take care.
Thank you.
That's a wonderful segue into the next half of our spaces, which, of course, is to bring on the highly anticipated inflation report that we do monthly out at Truflation, and that's no less than Oliver Roost. He's our head of product. It is a 16-page banger. It's charty. It's mathy. There's a provocative question right at the get-go that I'll ask him about stagflation, and he's of course everywhere as well. He's all over podcasts. He's on blogs, opinion pieces. He's everywhere. It's our head of product, Oliver Roost. Oliver, welcome back, man, and give us the skinny on February inflation.
Yeah, thanks for having me back, and it was a great conversation. And yes, I was being rather quiet to allow everyone else to make questions and ask questions. I tend to engage with Danielle quite a lot in the background, so hopefully that was exciting as it was for me. For February, look, the U.S. economy is been going pretty strong in Q1. The forecast is coming up at 2.1%. Lots of other forecasts are anywhere ranging from 2.1 to 2.5, which is a pretty strong economic growth. It's obviously lower than it was in Q4 last year. So that has cooled down a bit, but it's still, by government reporting purposes, and what they report on, it will be seen as a strong growth. And the big question, of course, as Danielle hit on, was the employment numbers. Again, the BLS on their employment situation report reported on, I think it was on Friday, that they had added 275,000 jobs to the market. Again, a lot of jobs in the government sector, as one of the guest questionnaires mentioned. And yes, the unemployment rate still increased by 0.2 percentage points. So again, a bit of an odd situation, much more than people expected. So generally, a pretty strong. Well, the sentiment in the market is that it's a pretty strong environment that we're living in, as well as from a labor standpoint, despite the fact that people are having two jobs and so forth, taking on more and more jobs, and despite there's more household debt, people are still spending, and Q1 is looking no different. The impact all this expenditure has on inflation is that we are predicting that deflation will remain sticky, and in particular core inflation. The volatile categories of food and energy will see quite a significant increase, especially food, which we believe is a core driver to the increase upward momentum because of commodity prices that have seen an increase in the past couple of months. So, for example, sugar, and now most recently cocoa, which will affect food prices in the long run. And of course, you have labor costs, and that's also affecting the eating out of home in restaurants, diners, as well as the grocery retailing business. But in general, there is a significant downward pressure from the goods category, and also at a milder degree, but to continued pressure from the services category, as we're seeing some of this slight easing, and I use the word slight easing of the employment market, and that's dropping a lot of the goods prices left, right, and center downwards, and driving the inflation rate downwards on the market. And the biggest contributor to that is new and used car vehicle purchases, and that's seen a significant drop again, due to a large inventory that's sitting in there, and the need to remove that. Plus, of course, government incentives, changes for the EV market, and also the high financing costs for purchasing a new car has caused that to drop significantly. So what does that mean at net? Where do we expect inflation to come in with tomorrow's report? The market is expecting anything. The lowest point of the range is at 2.7. The highest point of the range is 3.2, which is actually an increase from the previous number of 3.1. We're expecting it to come in at 2.9. And that's those are the drivers I mentioned earlier. The goods market is the main driver for downwards, but there is still upward pressure in them. And looking at the long-term outlook and further a couple of months ahead, next 3 months ahead, we're certainly starting to see inflation remain sticky and remain relevant, and it won't drop off as a lot of people are expecting. And I think the consequential impact for the Fed is most likely that we're definitely not going to see any reduction of the interest rates. Probably most likely, definitely not in March. Most likely the first rate of decrease is most likely to come in June at a 25% basis point reduction. So I've talked to quite a bit. I don't know if you've got any questions or comments that you want to delve into. I apologize for the monologue there.
No, it's all good. It's really kind of fascinating, considering what we just heard from DDB and her recessionary take. The stagflation idea, you addressed it in pretty good detail. That's scary. She basically said that it might be a relief compared to inflation. I'm sorry, compared to recession. What are your thoughts on that? How realistic do you think stagflation is, and do you think it is, a better, for lack of a better word, than a recession?
Yeah, I think it's So let me answer the first part of the question, the stagflation comments. So we've done a lot of research in looking at the data from the previous inflationary markets in times. And if you compare the inflationary environment that we're seeing today to the 1970s and 1980s, early 80s, you're seeing a literally almost identical trend line between what happened in the 70s versus what's happening now. And the causes for the stagflation in the late 70s and early 80s were driven by the Middle East wars, were driven by oil embargo and commodity price increases. And we're seeing similar factors affecting us today, whether it's the war in Ukraine, whether it's the Israeli-Hamas engagements, whether it's the oil prices starting to increase, whether it's cocoa, sugar, other commodities seeing increases, whether it's also the housing market starting to drive upwards because of the lack of supply. The similarities are pretty much identical. You look at the labor market, you look at drivers, they're all very, very similar. And so for us, the big question is, if there is no relief in the GDP growth numbers that's being reported, whether one believes that we're in a recession or not, but if there's no relief in that number, then you are going to see inflation hanging around a lot longer, if not increasing. And if it increases, which if the interest rates don't come down and the additional factors that we're talking about come into play, then we're going to go and see inflation rise again, which means that we get back into this stagflationary environment. And Jerome Powell, as much as he's been consistent, has communicated last week that he is going to be reducing interest rates. And if inflation goes up, his only toolbox is going to be keep inflation higher for longer. So that's our viewpoint currently about the similarities and why we think there could be stagflation on the horizon.
Yeah. I forgot to take into account world events like wars and so on. So that's really interesting. Did you happen to hear any or see any of the president's State of the Union where he addressed shrinkflation, and basically he said that there is going to be a soft landing. So that's kind of a inelegant way to ask if how much does the election this year play into the stagflation call or worry? Does it have any effect at all?
It should do, and as usual, the pressures of the two political parties will apply onto the pressures that's existing within and how to tackle inflation and other economic forecasts. Of course, Biden during his State of the Union address to how he got inflation under control, the Bidenomics, and how well it's doing. But I think you're already starting to see disputes between Yellen and Powell. And differences of views that are becoming more apparent. I think the difficulty and the challenge is going to be how much political pressure is going to come from either party to keep the unison of the FMOC members to a viewpoint of where they should be going on interest rates cuts this year and when they start and at what degree do they start. So I think we're a long way. There's going to be significant influences into that. And what the outcome of that is, time will tell.
Yeah, because Yellen is a pure political creature, whereas Powell, you could make some argument that he's semi-independent relative to the administration. So that's interesting that there's a tension between them. I guess it makes a certain amount of sense. We are heading into the final 10 minutes here of Truflation Spaces. If you have a question for Oliver, our head of product, and his inflation analysis, we'll bring you right up front here. Just request to speak. Comment, question, you're welcome to it. He is a encyclopedia of knowledge when it comes to this kind of stuff. So if you're interested in getting the full report, just go out to Truflation.com and click the pricing button and choose one of the Truflation Premium products, and you will get the report sent to you post haste. Go ahead, Joseph. Go ahead.
I actually have a question for Oliver. We see all this, those 5 million people that came to America illegally, right? And I was always wondering, the unemployment data and everything that they cover, do they take those people into consideration as well, or how does that work out?
It's a great question.
So the CPI, the BLS CPI doesn't necessarily. It has two ways that they collect the data. One is a straight price check of about 80,000 items. So that does not matter who is impacted or not. They go into a store and they check a price of, I don't know, butter from Walmart in Bentonville, for example, and they go back to that same store, same product, and check the price of that product a month later. Then they have a secondary element where these elements are not included, which is then they send a questionnaire out to 6,000 residents in the US across the nation, and they say, okay, do you rent your apartment? And you say, yes, I rent my apartment. And they say, okay, how much are you paying rent? But that email only goes out to, that survey only goes out to residents of the US that are registered in the system. So yes, in that case, those people, those immigrants coming across into the US are excluded from that survey.
But it was more of a question of like regarding the unemployment numbers, right? And because you said earlier that there was some, numbers were okay. There were some new jobs created, but what about those people that just came in? Like technically, they're not part of the census, right?
Yeah, they won't be included. They won't be included.
So that basically means that the real number is super unknown, right? We don't really know what the real unemployment number is. We don't really know what the real employment number is, because that 5 million makes up what, a percentage point of the whole total U.S. population, like 1.5% or something like that, right? So it's how do people make decisions when they don't even have the data, right? And they don't even care about the data or understand the data, and that's just something that is very interesting, and that's the problem that Truflation is actually solving. We actually go with data instead of sending a random survey to 6,000 people and finding out Walmart prices somewhere, right? And I don't know, just what's
and it's certainly 100% agree with you. And our focus has been on inflation, but in the last 6 months, we've moved off inflation, and we're looking at alternative data sets for labor market, for a whole raft of different. We've created an EV index, all these new alternative viewpoints of the market, rather than being just dependent on the government census, the Bureau of Labor and Statistics reports, right? And so that is our viewpoint, because I think we have one has to question the data sets and how much it's evolution, because even on the employment numbers, you look at the total workforce numbers, it's a mathematical equation the BLS comes out with. It says, okay, this number of people are being born, okay, they've gone through schooling, they should finish school at the age of 18 to 21. Once they finish school, they should be coming into the workforce. Therefore, this amount of people now at the age of 65 come off the workforce. And that's roughly how they calculate the employable workforce. And it's a lot more complex than that, but it's, simplistically, that's how they do it. And there's a lot more factors that come into play with this, and so therefore providing alternative measurement, alternative viewpoint to that is critical.
Yeah, excellent observation. We do have a question here. This would be Saffron. Saffron, go right ahead.
Hey, good morning. Thanks for hosting the space. Appreciate all of you being here and everybody taking the time to help educate everybody out there and come up with their own opinions. I have a question on real estate. Whenever I tend to agree with the stagflationary environment of maybe the 70s and 80s. Currently, I'm kind of looking into 79 to 85, so maybe a little bit later in the cycle than maybe what you guys agree with. But I do see a correlation, obviously, with some of the banking issues, the late 70s, early 80s, inflationary issues and whatnot. I'm a little confused on trying to understand some of and maybe somebody could shed some insight in this, or maybe what your speculation of anticipation in the real estate market might be. But what confuses me is I see, a bifurcated, housing economy because of inventory shortages in some areas, and then in other areas I see housing prices going down. Unfortunately, I happen to be in an area that I'm selling a house personally, and I'm watching the house prices go down consistently. So, that makes it a little bit tough. And every time I look to the charts on nationally, I see housing prices kind of edging up and staying kind of stagnant as well, comparable to that 79 to 85 range. I just wasn't sure if anybody had any insight on this stagflationary environment that we might be expecting, and what maybe to look for in the real estate market, and more, I guess, specifically in some of these markets that are starting to see a bit of a pullback already, in the last 6 months. What would a reasonable conclusion be, that they might continue to extend those losses, or just any opinion about that?
Excellent.
Yeah, so I think so. Yes, there are some areas, as you rightly say, if you break down the national number and you break it down into states and then into counties and so forth, you'll see significant differences. And I think in one of the key factors is that we also haven't seen a lot of movement of labor, right? So, and I hate to say this, but if we go back prior to the pandemic levels, we saw quite a consistent annual movement of labor during the summer for people taking on new opportunities, moving to different areas throughout, and traveling from one part of the country to the other part. And that we have not seen for quite a number of years. And that's starting, we're looking at some of the demographic shifts and population movements. We're starting to see evidence of that. But of course, when people move into those new areas that they have previously left from, the hesitancy to go into the market to purchase in terms of the real estate is significantly lower, partly because not only is the mortgage rates, the 30-year fix, are going up again, but the high financing costs, and what you previously owned, let's say, for a 4-bedroom apartment and paid for, you're now buying a 3-bedroom apartment. Or a house, or whatever it is. And I think some of that loss is resulting in people moving into the rental market for a period of time. And I haven't looked at the dissection of each of the state and the properties and county levels to see what the real estate market looks like from rental market versus a owner's market. But I can certainly follow that up with you afterwards. Certainly something we should be looking into, and we'll have a look into that. But I will say that the rental market and the owned property market are behaving in very different ways in the market that we're seeing. And the housing supply that everyone talks about, is really affecting the owner's market. In particular, people like yourself who are trying to sell your property. You're in the existing home market. It's not the new home market. And the existing home market accounts for roughly about 80% of the total housing market in the US anyway. And that market is seeing, on the national basis, an increase in prices because of the real lack of supply that people are putting their property on the market because of the higher cost that's coming out there. And so people are looking for higher price points to offset that. Now, are there areas and states and counties that are coming down? Yes. But I don't have a detailed assessment into that, but I can follow that up with you afterwards once we've completed that this month.
All good. Well, we appreciate everybody for tuning in, listening, all the great questions. Special thanks to Danielle DiMartino Booth and her team for making some time for us this morning. We are back again in just a few days on the 20th with Mark Yusko. So make sure you join us there. There'll be all sorts of promotions throughout our socials regarding that appearance during the FOMC meetings. Until then, head out to Truflation.com for Oliver's inflation report. Again, it's 16 pages with just about everything you'd need to possibly know. Really, really mandatory reading if you're investing. So thanks, everybody, for your time, your trouble. We really appreciate it. We always record these, so we repost them. You can use them if you missed any of the segments here as reference later on. Thanks again to our panel, our guest speaker, and we will see you in about a week. Goodbye, everybody.